If you're self-employed in roofing and putting money in the wrong retirement account, you could be leaving tens of thousands of dollars on the table. Here's what most reps get completely wrong about Roth IRAs versus solo 401ks. What's up, Roof Money Pros? Mike here with Roof Money Pro, and my mission is to help roofing professionals like you maximize your careers and build wealth. Now, if you're out there as a 1099 contractor or running your own roofing operation, you probably heard about Roth IRAs and solo 401ks and wonder which one you should actually be using. Here's the deal. Most reps either pick the wrong one for their situation or they don't understand how to use both strategically. Today, you're getting the complete breakdown on both accounts, the differences that really matter, and exactly which one makes sense based on where you are in your roofing career. And if this is going to help you, go ahead and smash that subscribe button because we're diving deep. Let's start with the Roth IRA because it's simpler and it's where most self-employed reps begin their retirement journey. One question I used to get all the time was, is a Roth IRA a good investment? The truth is, it's not an investment at all. A Roth IRA is an individual retirement account that holds your investments and where you contribute money that's already been taxed. The magic happens on the back end. All your growth and all your withdrawals in retirement are completely tax-free. You pay taxes now, never again. That's the core promise. For roofing reps early in their careers, this is incredibly powerful. Think about it. You're probably in a lower tax bracket now than you will be in 20 or 30 years after you've built a successful roofing business or wealth during your career. Paying taxes at today's lower rate and getting tax-free growth for decades is a wealth-building cheat code. The contribution limits change over time. For instance, the 2026 limit is $7,500 total for the year, which is up $500 from 2025 if you're under 50. You can put in $8,600 if you're 50 or older. Not massive amounts, but it's a starting point that's accessible for most reps even during slower income years. Here's why Roth IRAs work so well with inconsistent roofing income. You can contribute anytime throughout the year up until tax day of the following year. Got a huge commission in October? Throw a chunk in your Roth. Slow winter but a big spring? You can still make your contribution to count towards the previous year when the money shows up as long as it's made before the tax filing deadline. The flexibility matches your income pattern. The investment choices inside a Roth IRA are basically unlimited. You can buy index funds, ETFs, individual stocks, bonds, even some alternative investments depending on your custodian. Most roofing reps should stick with simple low-cost index funds, at least until a foundation is built. But the point is, you've got options. Another huge advantage, you can withdraw your contributions at any time without penalty or taxes. Notice I said contributions, not earnings. If you put $20,000 into your Roth over the years and it's grown to $30,000, you can pull out that original $20,000 whenever you want. The $10,000 in growth stays locked until retirement age, but having access to your contributions gives you a safety net that other retirement accounts don't offer. This makes Roth IRAs perfect for self-employed reps who might need emergency access to funds. You're building retirement wealth, but you're not completely locking yourself out of the money if disaster strikes. That peace of mind matters when your income swings month to month. That being said, avoid any complications entirely by making sure you have a strong cash reserve and a high-yield savings account to handle any of life's challenges that come your way. Now let's talk about the solo 401k, which is where things get really interesting for self-employed roofers. A solo 401k is designed specifically for self-employed individuals with no employees other than a spouse. If you're a 1099 contractor, you qualify. If you own a roofing company and you're the only employee, you qualify. The moment you hire your first W-2 employee who isn't your spouse, the solo 401k option gets more complicated. But until then, this is your playground. Here's what makes solo 401ks insanely powerful. The contribution limits are massive compared to a Roth IRA. For 2026, you can contribute up to $72,000 if you're under 50, or $80,000 if you're 50 or older. You heard that right. That's over 10 times what you can put in a Roth IRA. The way it works is you can contribute in two different ways. First, there's the employee contribution, which can be up to $24,500 for 2026. This is money you're setting aside from your self-employment income. Second, there's the employer contribution, which can be up to 25% of your net self-employment income. Since you're both the employee and the employer when you're self-employed, you get to make both types of contributions. Let's make this real. Say you had a killer year and your net self-employment income after expenses is $100,000. You could contribute the full $24,500 as an employee contribution, plus 25% of your net income as an employer contribution, which would be $25,000. That's $49,500 total going into your solo 401k in a single year. That's retirement wealth building on steroids. The tax advantage here is different from a Roth IRA. With a traditional solo 401k, you're getting a tax deduction for every dollar you contribute. If you're in the 24% tax bracket and you contribute $49,500, you just reduce your tax bill by about $11,880. That's real money staying in your pocket today. Now, always consult with your tax professional on what moves are best for your situation. Now, there's also a Roth option within most solo 401ks. You can make some or all of your employee contributions as Roth contributions, meaning you pay taxes now but get tax-free growth and withdrawals later. The employer portion always has to be traditional pre-tax, but having the Roth option gives you flexibility to split your strategy. The borrowing feature is huge for self-employed reps. Most solo 401ks let you take a loan from your account of up to $50,000 or 50% of your balance, whichever is less. You're borrowing from yourself and you're paying yourself back with interest. If you need capital to scale your roofing operation or cover a genuine emergency, this gives you access without penalties of an early withdrawal. Solo 401ks shine during big commission months or big income years. When you have a year where everything clicks and the money is flowing, the solo 401k lets you capture a massive amount in tax-deferred space. The Roth IRA's $7,000 limit feels like a joke when you're trying to shelter $50,000 or more. Now let's cut through the noise and focus on the differences that actually impact your wealth building. First, contribution limits. Roth IRA maxes out at $7,500 per year as of 2026. Solo 401k maxes out at $72,000 per year. If you're in a position to contribute significant amounts, the solo 401k wins by a landslide. But if you're early in your roofing career and you can only contribute $3,000 to $5,000 per year, the Roth IRA is simpler to set up and manage. Second, tax treatment. Roth IRA is tax-free growth with no deduction today. Traditional solo 401k gives you a deduction today, but you'll pay taxes on withdrawals in retirement. Roth solo 401k option gives you the best of both worlds. Tax-free growth with higher contribution limits, but you don't get the immediate tax deduction. Third, income restrictions. Roth IRAs have income phase-out limits. For 2026, if you're single and making over $168,000, you lose the ability to contribute directly to a Roth IRA. If you're married filing jointly and make over $252,000, same thing. Solo 401ks have no income restrictions at all. You can make $1 million and still contribute the full amount. Fourth, withdrawal rules and penalties. Roth IRA lets you pull out contributions anytime with no penalty. Earnings stay locked in until 59.5 or you face penalties and taxes. Solo 401k locks everything until 59.5, but you have the loan option to access funds if needed. Fifth, setup and administrative complexity. Opening a Roth IRA takes about 15 minutes online, just like opening a bank account. Opening a solo 401k requires more paperwork, choosing a custodian, and once your balance exceeds $250,000, you've got to file a Form 5500 with the IRS every year. It's not complicated, but it's an extra step. Sixth, which account is better early versus late in your income growth? When you're making $60,000 to $80,000 in your first few years of roofing sales, a Roth IRA makes perfect sense. You're in a lower tax bracket, you don't have huge amounts to contribute, and you want simplicity. As your income climbs to $100,000 or more, the solo 401k becomes essential because you need the contribution room and the tax deductions become more valuable. Let's dive into that a little deeper because here's where being in commission-based roofing sales creates unique challenges and opportunities. Roofing sales reps need flexibility in their retirement strategy because your income isn't steady. Some years you might gross $60,000. Other years you might hit $120,000. That volatility changes which account makes sense and when. The Roth IRA is perfect for establishing a baseline retirement habit because the low contribution limit means you can hit it even during moderate income years. If you make $50,000 in a slower year, coming up with $7,000 for a Roth contribution is tough, but doable. It keeps you in the game. But when you have a banner year where you gross $150,000 in commissions, that $7,000 Roth limit is not good enough. You've got big tax exposure and you need big deductions. This is when the solo 401k becomes critical. You can dump $40,000, $50,000, or more into the solo 401k, massively reduce your tax bill, and accelerate your retirement wealth. Here's the strategic play. Use both accounts together. Contribute to your Roth IRA consistently every year to build that tax-free foundation. Then, in years when income jumps, max out a solo 401k contribution on top of the Roth. You get tax-free money growing in the Roth, tax-deferred money growing in the solo 401k, and you've optimized for both today's taxes and future flexibility. Variable income also impacts how you think about traditional versus Roth contributions within the solo 401k. In a high-income year, traditional pre-tax contributions give you immediate tax relief when you need it most. In a lower income year, Roth contributions make more sense because you're paying taxes at a lower rate. The solo 401k loan feature becomes even more valuable when you're dealing with income volatility. If you have a string of slow months and need cash flow but don't want to kill your investing momentum, borrowing from your solo 401k keeps you afloat without derailing your retirement plan. Just make sure you're disciplined about paying yourself back. Let's talk taxes because this is where self-employed reps either build massive wealth or get destroyed. Quick disclaimer, this isn't meant to be tax advice. When you're self-employed, you're paying both the employee and employer portions of Social Security and Medicare taxes. That's 15.3% right off the top before income taxes even start. Anything you can do to reduce your taxable income has a multiplied effect. Traditional solo 401k contributions reduce your self-employment income, which means you're paying less in both self-employment taxes and income taxes. If you contribute $50,000 to a traditional solo 401k and you're in the 24% income tax bracket, plus the 15.3% self-employment tax, you're saving roughly $19,650 in taxes. The number one gripe I hear is that I can't touch that money until retirement. Sure, but that's money that stays in your possession and is working for you instead of going to the government. Roth contributions don't reduce your taxable income today, but they eliminate taxes in the future. Here's why that matters for roofing pros. If you build a $2 million Roth IRA over your career, every penny of that comes out tax-free in retirement. If you build a $2 million traditional solo 401k, you're going to pay potentially $500,000 in taxes or more when you withdraw it depending on your tax bracket at that time. Self-employed roofers also need to think about future tax assumptions. Tax rates have been historically low in recent years. There's a real possibility that taxes can go up in the future. Having money in both traditional and Roth accounts gives you flexibility to manage your tax situation in retirement based on whatever the tax landscape looks like decades from now. And don't forget about state taxes either. If you're in a high tax state now, but planning to retire in a no tax state like Florida or Texas, traditional contributions give you a deduction at high state rates today, and you'll withdraw in retirement with no state tax. That's a huge advantage. Let's get tactical about how to actually contribute to these accounts when your income looks like a roller coaster. For Roth IRA contributions, set a baseline goal based on your lowest expected income year. If you know you'll make at least $40,000 even in a terrible year, commit to contributing at least $3,000 to $4,000 to your Roth no matter what. Make this non-negotiable. In bigger years, you bump that up toward the max. The key is contributing throughout the year instead of trying to do it all at once. Set up automatic monthly transfers of $300 to $500 based on what you can sustain. During big commission months, make lump sum contributions on top of your baseline. You've got until tax day of the following year to max out your contribution. So if you have a slow start to the year but a strong finish, you can catch up in November and December plus the first few months of the next year. For solo 401k contributions, think in terms of percentages of income rather than fixed dollar amounts. Commit to contributing 15 to 25% of your net self-employment income. In a $60,000 income year, that's $9,000 to $15,000. In a $120,000 year, that's $18,000 to $30,000. The percentage stays consistent, but the dollar amount flexes with your income. The beautiful thing about solo 401k contributions is you've got until your tax filing deadline, including extensions, to make them. That means you can literally wait until you do your taxes to see what your final income was, calculate your maximum contribution, and then make a lump sum contribution before you file. This removes all the guesswork during the year. Here's the move for hitting the Roth IRA max before year end. In November, look at what you contributed so far and calculate how much you have left to max out. If you contributed $4,000 and you need another $3,000, figure out if you can squeeze that in from November and December income. If you can, do it. If not, plan to make the remaining contribution in January or February of the next year before tax day. For solo 401k contributions, especially in high income years, work with your accountant to calculate exactly how much you can contribute. The employer portion is based on net self-employment income after accounting for self-employment taxes and other deductions. The math gets a little complex, so don't just guess. Run the actual numbers or you might over-contribute and trigger penalties. Using a tax advantage account and an investing account together is smart for self-employed reps. Max out your Roth IRA first for the tax-free growth. Then max out your solo 401k for the tax deduction and higher limits. If you still have money left over, invest in a regular taxable brokerage account. This gives you retirement money, tax advantage money, and accessible money all working together. Avoid the mistake that triggers tax penalties. Don't contribute more than your net self-employment income. If you only made $30,000 in net income after expenses, you can't contribute $40,000 to retirement accounts. The IRS will hit you with penalties and you'll have to pull the excess out. Always contribute based on what you actually earned, not what you hope to earn. Let's walk through a real scenario so you can see how this plays out in actual numbers. Meet Stetson. He's 32 years old, been doing roofing sales as a 1099 contractor for 5 years. Year 1, he made $45,000 in net income. Year 2, he made $62,000. Year 3, he made $58,000. Year 4, he made $89,000. Year 5, he made $118,000. His income is growing, but is volatile year to year. In years 1 through 3, Stetson focused only on his Roth IRA. He contributed $4,000 in year 1, $6,000 in year 2, and $5,500 in year 3. Total invested, $15,500. Because he's young and a low tax bracket, paying taxes now and getting tax-free growth made perfect sense. His Roth IRA is now worth over $19,000 with investment growth. In year 4, Stetson opened a solo 401k. He maxed out his Roth IRA again at $7,500, then contributed $20,000 to his traditional solo 401k. That $20,000 contribution saved him about $7,800 in taxes between income taxes and self-employment taxes. He reduced his tax bill by $7,800 and increased his retirement savings by $20,000. That's a massive win. In year 5, his big year, Stetson maxed out his Roth IRA at $7,500 and then dumped $45,000 into his solo 401k. He split the solo 401k contribution. $20,000 went traditional for the tax deduction, and $25,000 went Roth for tax-free growth. This gave him the best of both worlds. The $20,000 traditional contribution saved him about $7,800 in taxes again. The $25,000 Roth contribution cost him taxes today, but will grow tax-free for the next 30 years. By using both accounts strategically based on his income each year, Stetson now has about $115,000 in total retirement savings. If he keeps this up and averages $90,000 in income with similar contribution patterns, he'll have over $2 million by age 60, even with volatile income. Compare that to his buddy Jason, who makes similar income but never opened any retirement accounts because he didn't understand the options. Jason is 32 with zero retirement savings. Stetson is on track to retire wealthy. Jason is on track to work until he physically can't anymore. The combined account strategy also gives Stetson tax flexibility. He's got over $25,000 in his Roth IRA that will never be taxed again. He's got about $90,000 in traditional and Roth solo 401k money. As he continues contributing over the years, he'll have money in multiple buckets that he can pull from strategically in retirement to minimize taxes. The long-term wealth impact is staggering. If Stetson's $115,000 grows at an average 8% annual returns for the next 28 years, he'll have over $1.1 million by age 60 even if he never contributed another dollar. But he will keep contributing, and that number will likely exceed $2 million or more. That's the power of starting early and using the right accounts. Let's make this dead simple so you can make a decision today instead of overthinking for 6 more months. If you're a beginner, meaning you're making under $60,000 in net self-employment income, and you're new to investing, start with a Roth IRA. It's simple, the contribution limits are manageable, and you're locking in tax-free growth at a low tax rate. You can easily open an account at a discount broker like Fidelity, Vanguard, or Schwab, set up automatic monthly contributions, and choose just a simple index fund to get started. Done. If you're a mid-level earner, meaning you're making $60,000 to $100,000 in net income, open both a Roth IRA and a solo 401k. Max out the Roth IRA first because it has the lower contribution limit. Then make solo 401k contributions with whatever else you can afford. Start with small solo 401k contributions if needed, but have the account open and active. As your income grows, you'll scale up the solo 401k contributions. If you're a high earner, meaning you're consistently making over $100,000 in net income, prioritize maxing out a solo 401k first, especially with traditional pre-tax contributions for the massive tax deduction. You're in a high tax bracket now, so every dollar you defer saves you 32 cents or more in taxes. Then contribute to a Roth IRA if your income allows, or use the backdoor Roth IRA strategy if you're above the income limits. If you're a business owner with employees, meaning you're not just a 1099 contractor, but you actually have W-2 employees, the solo 401k likely won't work for you once you hire that first employee. You'll need to look at SEP IRAs or standard 401k plans. But if you're currently solo, max out the solo 401k benefits while you can. One sentence summary for each scenario. If you're making under 60K, do Roth IRA only. If you're making 60 to 100K, do both Roth IRA and solo 401k. If you're making over 100K, max out the solo 401k and use backdoor Roth if needed. If you're self-employed in roofing sales, choosing between a Roth IRA and a solo 401k isn't about guessing. It's about aligning your retirement accounts with your actual income pattern and tax situation. A Roth IRA gives you tax-free growth, simple setup, and contribution flexibility that works even in slow years. A solo 401k gives you massive contribution room and powerful tax deductions when your income takes off. The reps who build real retirement wealth aren't the ones who make the most money. They're the ones who consistently put money into the right accounts year after year, regardless of income swings. Your future wealth depends way more on your discipline than your account choice. But picking the right account for where you are accelerates everything. Now, all of this means nothing if you don't have clarity on how to manage your money. If you want a complete system to manage your variable roofing income, forecast your sales with precision, and automate your retirement contributions so nothing falls through the cracks, then check out the F.E.A.S.T Money Management course. It's specifically designed for commission-based roofers who need to manage irregular income like a pro. You'll get the exact allocation system, percentage formulas, and automation strategies that successful roofing pros use. Click the link in the description to get more info on how to enroll. Stop guessing and start building real wealth today. And if you found value in this video, be sure to subscribe because I'm dropping weekly financial strategies built specifically for roofing professionals. See you in the next video.